Well, the base case is that we'll see a combination of fiscal and monetary support that will prove a very good environment for fixed income assets, particularly credit assets in 2021. There might be the risk of asset price bubbles rising, but there's lots of room for the Fed to maneuver within their new monetary policy framework. Therefore, we see ample room for credit spread compression in 2021, with the caveat that total returns for longer duration assets may face moderate headwinds if growth picks up, and that puts pressure on the government bond market. Mainly, though, the threat of negative rates generating a halo effect for income-producing assets is going to be the dominant force. Highly geared issuers and economic sectors dependent upon COVID containment prior to a full resumption of growth may face a little bit of a longer road to recovery, but the primary condition of being an early cycle economic recovery plus high balance sheet leverage usually poses tailwinds for credit returns as we move deeper into the recovery cycle. So the rebound in the real economy may be significantly slower than what we see in asset markets next year. On the positive front, very effective vaccines and therapeutics combined with more pro-stimulus stance from Republican senators would really kickstart the markets into 2021. The front-loaded fiscal stimulus closing output gaps faster than expected, and a reduction in geopolitical and trade tensions would add further tailwinds to a significant drop of household savings rates and increase in bank lending demand that should drive spread compression. On the negative front, really the main issue that we're dealing with now relates to vaccine rollout and teething troubles with the logistical complexity related to that. If we see that cause some stickiness, it's going to create the potential for another wave of fallen angels and second small peak in defaults, and could really be exacerbated by weak fiscal stimulus and rising geopolitical risk. High COVID impact sectors likely offer the greatest risk-reward prospects for next year. So energy, leisure, transport, gaming, lodging, and retail, for example, are the areas where we would anticipate we're going to see the greatest volatility. But with precautionary liquidity raised by both IG and high-yield companies no longer necessary, those entities will either prioritize debt repayment, which will support credit fundamentals and decrease potential supply. There could be a little bit more of an uptick in M&A to consolidate sectors, which could add to the supply picture, but we're not fearful of that. We think the risks are really in the financial and SME sectors, where if we see a lackluster recovery, we'll have another reckoning with respect to delinquencies, forbearance, and provisioning that could create some problems for those sectors.